But that puts silver at a minimum between $70 and $140 per ounce, if without re-establishing this gold collateralization. But if we look at 1980 levels, that could potentially put silver at $580 an ounce.
Now, Andrew, with silver joined at the hip to gold, where do you see the silver prices for our silver community? Where do you see it priced into such gold, like this reset that's happening right now?
Yeah, great question, Shane. And because silver has been acting extremely poorly, and we all know it's to do with the capping of this OCC derivative position, the millions of ounces that have been sold short, and its direct relationship to SLV, which enables any physical buying to be flywheeled and not purchased. Now, the gold-silver ratio is currently at a ludicrous 86 to 1. So let's look at the numbers. Even if we don't adjust this, just leave it at 86 to 1. Obviously, this is a paper-centric level, but that puts silver at a minimum between $70 and $140 per ounce, if without re-establishing this gold collateralization. But if we look at 1980 levels, that could potentially put silver at $580 an ounce. Now you have to think nickel before dismissing this physical supply demand price. And as we covered in our last episode, while it was and is possible to halt trades on the siloed backwater of the LME, silver is a deliverable global foreign exchange currency cross, trading alongside the dollar, the euro, the yen, etc. And no such market halt could be instigated without causing all the too big to fail over-the-counter liquidity providers to crash and burn. You cannot segregate one of the foreign exchange crosses against the dollar. The March 2020 EFP blow-up triggered an $18 price ramp. That would be absolutely minuscule in comparison to a call on silver to physically back up the BRICS basket. Now, while SLV has been enabled to flywheel physical silver investments into unallocated credit positions, and most Western traders would be red flagged by the cartel, including us, if front-running them a producer, you go in and try and take product from a producer anywhere in the world virtually, they control the metals accounts of most producers. Therefore, you're red flagged if you come and try and do it. And what they'll do is block you and red flag you from ever buying any silver again from any of the major outlets. But they won't be able to red flag a physical silver required to fulfill the BRICS commodity basket. You're talking about something that is central bank organized. This is going to blow up the siloed OCC derivative position. I'm absolutely certain of that. Once you've removed this containment, then the whole thing is game on. Now, once gold breaks loose of its unallocated collar, silver is going to too, Shane. I mean, this puts the gold-silver cross closer to 16 to 1. We had Bill Halter talking about why 16 to 1. Made a lot of sense. Put a short squeeze on silver, and this ratio becomes magnetic. And once we see the unwind of the unallocated collar, I see silver's fair value somewhere around 375 to 750 bucks if the dollar fails. It's not going to be good. If the dollar really fails, it won't be gold trading at 2,500 an ounce. Look, I'm not saying silver is going to trade at 2,500 anytime soon, as higher physical prices as they emerge will bring physical to the market and a real physical price will settle. We don't know what that is, but it's a hell of a lot higher. But looking at a potential for an over-the-counter nickel-like explosive derivative bomb, we cannot ignore that it was Bloomberg who publicly assessed a benchmark of 250 to 1 leverage for silver. They noted that on the transition date of the all-new silver fix on August the 15th, 2014. So back then, Bloomberg assessed that the global paper silver market was valued at 5 trillion, including options, ETFs, etc. Now, as it happened, silver was trading around 20 bucks then. There, no containment there, is there? With annual production at around 1 billion ounces, okay, very close to current metrics. So let's look at how nickel-like the silver derivative market really is at this juncture. And as we discussed last time, a 250 to 1 insiders are currently leveraging $5,000 silver. This is ludicrous, but it's the game. Please, and that explains how they can control this price. Please do not discount these targets. We're encountering an unprecedented circumstance with footprints evidencing the old cabal buying physical gold and silver hand over fist, and the specs are the patsies here.
Hey, Andrew, just before we started recording, as usual, you provided some good context to what we're seeing in the very, very short term from a wholesale market perspective. Can you share with our subscribers what you were talking about here?
Yeah, really pleased to, Shane. So very short term, looking at the wholesale physical markets, we continue to evidence a steady safe haven physical demand from India and Asia, which has up to now become a sell pivot for the specs at every pit open. If you look at the pit opens, you see that's where the selling starts every single time, almost relentlessly. But as we evidenced as this week has progressed, with the spec selling open interest running thinner, the house has been quicker to take the net long side, overrunning these automated pit sellers who are mindlessly correlated to the rising dollar index and bond yields, and of course inversely to the ES algo that we just described. Now, looking at the global picture with a particular focus on the all-important Russia-China physical gold alliance, there's a couple of things we really observe. Although the gold price in dollar terms has posted a very large $290 correction from it was at 2,078 on the 8th of March, all the way through to 1785 spike low on the 16th of May, the SGE gold price recorded a much, much smaller decline due to the yuan's depreciation. Now, conversely, the ruble foreign exchange cross versus the dollar has reverted from Biden's rubble assessment, strengthening all the way to 2017 highs against the dollar during the same period, into this $290 US dollar gold price sell-off. However, into this COMEX-driven price decline, ruble gold was noted to be in extremely strong demand, with the ruble price of gold actually rising strongly, but offset in dollar terms by the stronger exchange rate. Obviously, that equation lowers the price in US dollar terms, but not in ruble terms. Now, the silver COMEX managed money positions, in the meantime, these are things to note, have returned to net short for the first time since June 2019. You know who's going to win this. If you're short against the house, you know the house is going to take you the long side. And we know that the SLV price is benchmarked at the silver fix, and given the counterintuitive heavy action into a strong physical demand, it's clear there are efforts to fix the derivative price as low as possible as part of the efforts to unwind the related deeply underwater OCC position. Now, notably, each fix this week and last week was banked progressively lower, but backwardations, i.e. the silver price, futures price, much, much lower, deeply lower than the spot price, illustrates it's the commercials who are long against the specs, and it's impossible to hide those footprints. So spec short stops above the market are once again extremely attractive in both gold and silver futures. Structurally, we have not evidenced such a bullish setup since gold was at $1,170 in August 2018 and silver at $12 in March 2020. So Shane, to sum up, in the words of Robert Kiyosaki, how much physical do you have, guys?